Here's a strange one. A company's stock has fallen 34% over the past year, yet 12 Wall Street analysts are calling it a buy, with a price target of $41.82, nearly 40% above where the stock sits today. That company is Genpact Limited, ticker G. If the stock has been sinking this badly, why do the people who study it closely still see room to rise? Let's follow the numbers and find out. Genpact's market cap, the total value of all its shares combined, is $5.07 billion. Add in its debt and subtract its cash, and you get what's called enterprise value, a rough estimate of what it would cost to buy the whole business outright, and that comes to $5.74 billion. Right away, we see debt outweighing cash. Keep that in mind because we'll come back to it. First, let's see if the business itself is actually healthy. Over the last 12 months, Genpact brought in $5.16 billion in revenue and kept $569 million of that as profit, giving earnings per share of $3.26. That's a real profitable business. And here's where it gets interesting. With the stock price so beaten down, the trailing P/E ratio, which compares share price to yearly earnings, sits at just 9.18. The forward P/E, based on expected future earnings, is even lower at 7.22. A lower P/E usually means the stock is cheap relative to what it earns. That seems straightforward until you check the P/E-G ratio, which weighs price against both earnings and growth together. It comes in at 0.72, well under 1, often a sign a stock is priced cheaply relative to its growth. So if the fundamentals look this reasonable, why has the stock dropped so much? Let's check how efficiently the company runs. Return on equity, how much profit it generates from shareholders' money, is a strong 23.12%. Return on invested capital, which measures profit generated from all capital, debt, and equity combined, is 18.32%. Those are healthy numbers, but here's a detail many investors overlook. Genpact employs 145,000 people, yet generates only $35,593 in revenue per employee and just $3,929 in profit per employee. This is a labor-heavy business where growth doesn't scale as easily as it does for software companies. Now follow the cash, operating cash flow. The actual cash generated from running the business was $748.89 million. After $80.15 million spent on capital expenditures, the equipment and infrastructure needed to keep operating, Genpact was left with $668.73 million in free cash flow, money it's genuinely free to use. Compared against its market cap, that gives a free cash flow yield of 13.62%, a substantial return for a company this size. Where does that cash go? Genpact pays an annual dividend of $0.75 per share, a 2.51% yield, and that dividend has grown 10.85% in just the last year, marking 8 straight years of increases. Yet the payout ratio, the portion of profit paid out as dividends, is only 21.93%, leaving plenty of room to spare. The company has all been buying back its own shares, shrinking the share count by 2.40% over the year. Combined, the dividend and buybacks add up to a shareholder yield of 4.99% flowing back to investors. Now the picture starts becoming clearer, but there's still that debt question. Genpact holds $930.17 million in cash against $1.76 billion in total debt, a negative net cash position of $827.75 million. That sounds worrying until you check whether the company can actually handle it. Debt to EBITDA, comparing debt to earnings before interest, taxes, depreciation, and amortization, is a manageable 1.88. Interest coverage, how many times over the company can pay its interest from operating profit, is a comfortable 9.95 times. The current ratio, short-term assets against short-term liabilities, is 1.69, meaning near-term obligations are well covered, and the Altman Z-score, a formula estimating bankruptcy risk, sits at 3.38, generally considered a safe zone, and this changes how the earlier numbers should be viewed. But not everyone is convinced. Short interest shares investors have bet against stands at 17.83 million, or 10.52% of all shares outstanding. That's a meaningful amount of doubt still hanging over this stock. So here's where the clues land. Genpact is a profitable, cash-generating business trading at a historically low valuation, with strong returns on capital, manageable debt, a growing dividend, and steady buybacks. At the same time, its growth relies on hundreds of thousands of employees rather than software-style scale. Its stock has fallen sharply over the past year, and a real slice of the market is still betting against it. The numbers describe a company that looks cheap and disciplined, yet one Wall Street hasn't fully embraced. So what do you think is really driving the gap between Genpact's steady fundamentals and its falling stock price?